Hi everyone, welcome to my YouTube channel Learn Commerce with Namita. I'm Namita Mane. In today's video, we are going to start a new topic of financial accounting, class YBCOM. The topic is amalgamation of partnership firm. In this video, we are going to study what do you mean by amalgamation of partnership firm, the objective of amalgamation of partnership firm, then accounting treatments for amalgamation of partnership firm. So without wasting time, let's start the session. First, we will try to understand what do you mean by amalgamation of partnership firm. Now, what is amalgamation? Basically, amalgamation means when there are two or more firms or when there are two or more companies come together to form a new company or new firm is called as amalgamation. So, amalgamation is what? It is a combination of two or more firms, partnership firm, into a new entity by combining the assets and liabilities of both the entities into one. It means that the combination of two or more firms, they are coming together to form a new firm, and whatever is the assets and liabilities of old partnership is taken by the new firm. That is nothing but amalgamation of partnership. Now, under amalgamation, two or more firms transfer their business to a new firm. Next, when two or more existing partnership carrying on same type of business come together by ending their separate entity and form a new firm, it is called as amalgamation of partnership firm. Now, for example, suppose there is A and B firm. This is one partnership, and second C and D firm. This is second partnership. So this both the firms are coming together to form a new partnership that is called as ABCD new partnership firm. Now, when there is a new partnership forming, that means the old partnership A and B and C and D, all the assets and liabilities of this both the partnership firm will be taken over by the new partnership firm. So this is the meaning of amalgamation of partnership firm. Now, how the formation of amalgamation take place? There are three possibility ways where amalgamation can take place. First is two or more existing sole proprietors, they come together to form a new partnership. Okay, for example, A is a sole proprietor and B is a second sole proprietor. They can come together to form a new partnership firm. This can be one way for the amalgamation. Second is one existing partnership firm can come with one existing sole proprietor to form a new partnership firm. This is the second formation of amalgamation. Third, two or more existing partnership firm can come together to form a new partnership firm. So in these three ways, the amalgamation of partnership firm can be taken place. Now, what are the objectives of amalgamation of partnership firm? Now, why amalgamation is needed or for partnership firm? First of all, to eliminate or to reduce the competition amongst themselves, amongst the firm. Second, to minimize the common expenses of businesses like sell promotion, advertisement and etc. So there can be some common expenses of the businesses. Because of amalgamation, it can be eliminated or it can be minimized. Third is to get the benefit or to get the advantage of large scale production. To rely the additional capital required for the development and expansion of business. To minimize some fixed expenditures in business, there in partnership firm business there can be some fixed expenditures. Due to amalgamation it will be minimized. Then there can be some new technology adopted. So to utilize that new technology amongst each other, there can be the amalgamation of partnership firm. So these are the objectives of amalgamation of the firm. Now next we will see the accounting treatment for amalgamation of partnership firm. Now in amalgamation of partnership firm, there are some accounting treatment and some ledgers account to be prepared. Now why this is required for the accounting treatment? Because when there is a new formation, the old firms assets and liabilities are being taken over. So what is the steps to take over the assets and liabilities? Which accounts to be maintained? Okay, because when there is a new formation of a new firm, so the old firms books of accounts are to be closed. So we have to follow some steps. So accounting treatment and preparation of ledger account. Now during the process of amalgamation, once two or more firms amalgamate, the old firms lose their identity. Okay, and and in the place of emergence, the identity of one new amalgamated firm is identified. Okay, so in that case the amalgamated balance sheet is prepared, where all the assets and liabilities are taken over at some agreed values. These are being transferred. Then also the partners capitals are transferred to the amalgamated balance sheet. Okay, so old partnership firms books are to be closed. Now there are steps to close the books of amalgamating firm. First, when two or more partnership firms amalgamate to form a new partnership firm, the books of accounts of the old firms are to be closed. So there are some particular steps which is to be followed while closing the books of amalgamating firm, means the old firms. Now first step is we have to prepare revaluation account. Okay, after preparing revaluation account, second we have to prepare the partners capital account. Third, the realized assets which are not taken over by the new firm, it is to be transferred to the capital account. That transfer is to be done in the partner sharing profit ratio. Okay, fourth, discharge those liabilities which have not been taken over by the new firm and transfer such undischarged liabilities to the capital account of all the partners in the ratios of capital. Fifth step is we need to transfer all accumulated reserves or profit and loss to the capital account of all the partners in their old profit sharing ratio. Sixth step is to close the accounts of liabilities taken over and the accounts of assets taken over. Okay, and seventh is close the partners capital account. So these 7 steps we have to follow while we are closing the books of accounts of the old partnership firm, means the firm which is amalgamating. Okay, like A and B, C and D, these two are the old firms. They are closing their books of account, they are transferring their assets and liabilities to the new firm. So they will follow all these steps. Now now we have to pass the accounting entries, means the journal entries in the books of old firm. Now when uh, the accounts have been closed, okay, of the old firm, there are some necessary journal entries and accounting entries which is to be passed in the books of old firm. So closing accounting entries, or you can say closing journal entries on revaluation of assets and liabilities in the books of each of the old firm. Okay. Now suppose when the assets are taken over at appreciated value, then the the journal entry will be assets account debit to revaluation account. When the assets are taken over at a appreciated value, means at increased value, then assets account will be debited and to revaluation account credit. Now when the assets are taken at depreciated value, means at a decreased value, revaluation account debit to assets account credit. Now, when the liabilities are taken over by the new firm, if the liabilities is in increase, appreciated value, revaluation account debit to liabilities account. When the liabilities are taken over at a decreased value, means at depreciated value, then liabilities account debit to revaluation account. Now suppose the assets and liabilities are not taken by the new firm, but those assets and liabilities are taken by the partners, okay, in the capital ratio. Then when the assets are taken over, the account entry will be, the journal entry will be partners capital account debit to assets account. When the liabilities are taken over by the partners, then liabilities account debit to partners capital account. Suppose when the assets and liabilities Suppose when the assets and liabilities are sold and paid off respectively, then in that case, when the assets are sold, the entry will be cash or bank account debit to asset account, and when liabilities are paid off, liabilities account debit to cash and or bank account. Now, when the closure of revaluation account is done, so closing of revaluation account, in that case, the profit or loss on revaluation account is to be distributed amongst the old partners in their old profit sharing ratio. Suppose there is a profit on revaluation account, that means the credit balance to revaluation account. In that case, the journal entries will be revaluation account debit to each partner's capital account. Suppose there is loss on revaluation account, that means the debit balance to revaluation account, then each partner's capital account debit to revaluation account credit. These are the entries which you have to pass in the old firm. Now there are some undistributed profit and loss. Suppose there is undistributed profit, then in that case it is to be credited to partners capital account in the old profit sharing ratio. The entry will be journal reserves account debit to each partner's capital account. Suppose there is undistributed losses, it is to be debited to the partner's capital account in the old profit sharing ratio. The journal entry will be partner's capital account, means each partner's capital account debit to profit and loss account credit. Now there are some unrecorded assets and liabilities. The entry for the journal entries for unrecorded assets and liabilities is as follow. Assets account, suppose there are unrecorded assets, then in that case the journal entry will be assets account debit to revaluation account. For unrecorded liabilities, the entry will be revaluation account debit to liability account. Next, journal entries. Suppose there is some creation of goodwill or goodwill adjustment is there, the entry will be, so when goodwill is given in the balance sheet of the old firm and there is any increase or decrease in its value to be made, it will affect revaluation account. So the goodwill, if the goodwill is increase in goodwill amount, goodwill account debit to revaluation account credit. Suppose there is decrease in the goodwill amount, then revaluation account debit to goodwill account. Now if goodwill is not given in the balance sheet and is raised, then it is a credited to partners capital account in the old profit sharing ratio. The journal entry will be, if the goodwill is not given in the balance sheet, in that case goodwill account debit to each partner's capital account. So these are the journal entries, possible journal entries which is to be passed in the books of old firm. Now the journal entries, accounting entries or journal entries in the books of new firm. So the opening entries in the books of new firm will be the assets and liabilities taken over. Okay, because the old firm is transferring all their assets and liabilities to the new firm. So what are the assets and liabilities, at what rate, at what price the assets and liabilities are taken over, it has to be recorded in the books of new firm. So assets account debit to liabilities account credit to partners capital account credit. Second, capital adjustment. So in that case, if partners actual capital is less than the required capital, the entry is cash or bank account debit. So if partners actual capital is less than required capital, the account entry, the journal entry will be cash or bank account debit to partners loan account or partners current account debit. When the cash not specified, then to partners capital account. If partners actual capital is more than required capital, in that case partners capital account debit to cash or bank account credit to partners loan account or partners current account credit. Then for goodwill adjustment, retainment of goodwill, if the total goodwill is to be retained or not to be written off in the books of new firm, it is to be shown as an assets in the amalgamated balance sheet. When the goodwill is written off, if the total goodwill is to be written off from the books of new firm, it is to be debited to all the partners capital account in the new profit sharing ratio. The entry will be partners capital account debit to goodwill account credit. Now once the journal entries are passed in the new books of new firm, we have to prepare the amalgamated balance sheet. So amalgamated balance sheet will consist the following things, like all the assets and liabilities at the agreed value. This amalgamated balance sheet is of the new firm. So all the assets and liabilities at the agreed value, then new capital of all the partners, then adjusted cash balance. Fourth will be partners current account or partners loan account, as and when the case will be. So these four things will consist in the balance sheet or in the amalgamated balance sheet. Now there are few things which you have to follow while preparing the amalgamated balance sheet. Means there are some important points to be noted while preparing the amalgamated balance sheet. First is, if the purchase consideration is more than the net assets, that means asset minus liabilities taken over, it should be treated as goodwill in the books of firm. Okay, so when the assets are more than the liabilities, it is to be treated as goodwill. So when the purchase consideration, okay, is less than the net assets taken over, it is to be treated as capital reserve. When the purchase consideration is less than the net assets taken over, it is to be treated as capital reserve. Now remember one thing, that revaluation account is opened when the assets are retained in the same business. In that case, the revaluation account is opened. If realization account is opened, in that case the assets are sold and the books of accounts are closed of the old firm. Now balance on the reserves and surplus account of firm is to be credited to the partner's capital account in the old profit sharing ratio. Goodwill of firm is to be adjusted by crediting the partner's capital account in the old profit sharing ratio. So to assure that the result claims of the partners is equal to the purchase consideration and the no account is left with the balance. So these are the important points which is to be followed while preparing the amalgamated balance sheet. Now the next point is preparation of ledger account in the books of old firm. Now there are methods of accounting to be followed in amalgamation of partnership firm. There are two methods. One is revaluation method and second is realization method. So when revaluation method is used, when the assets are retained in the same business, we open revaluation account. When the assets are sold and books of accounts are closed, then realization account is opened. So we use realization method. In the case the assets are retained in the same business, revaluation method we are using to follow the accounting treatment in the amalgamation of partnership firm. Now revaluation method. In amalgamation, when assets are retained in the business, in the same business, a revaluation account or profit and loss adjustment account is opened for accounting treatment to implement the scheme of amalgamation. Accounts of assets and liabilities are closed through revaluation account. Revaluation account is to be prepared to find the profit and loss on revaluation of assets and liabilities, which is transferred to the partner's capital account in the old profit sharing ratio. Now there are accounting procedure to be followed in the books of old firm while we are using revaluation method. So first step is, first open revaluation account or profit and loss adjustment account, partners capital account and new firms account. Second step is to transfer all the opening balances to the respective ledgers account like revaluation account, partners capital account or new firms account. Third step, distribute the journal reserves or profit and loss account credit balance amongst all the partners in their old profit sharing ratio. Fourth step is the value of goodwill as per the term agreed upon and account for it. Fifth step, revaluation of assets and liabilities. Sixth step, dispose of the assets and liabilities which are not taken over by the new firm. It can be taken by the partners. Seventh step is to find out whether there is a profit or loss on revaluation and uh, account and distribute amongst the partners in their old profit sharing ratio. Eighth step is transfer assets taken over to new firm's account at the agreed value. Ninth step is transfer liabilities taken over to the new firm account at the agreed value. And last step, that is 10th step, is transfer the capital balance to new firm's account. At this stage, the new firm's account will be closed. Now, accounting procedure in the books of new firm. When we are following the revaluation method, in that case, what are the steps which we have to follow while passing the entries in the books of new firm? First, record the purchase of business. Second, write off the goodwill. Third, adjust the capital account of all the partners. Okay. Now, realization method. When the sums are asked, when in examples it will be asked that close the books of old firm by using revaluation method or by using realization method. So for revaluation method, these steps we have to follow. For realization method, the following steps we have to follow. So in amalgamation, when assets are sold and books of accounts are closed, a realization account is opened for the accounting treatment. Under this method, a realization account is opened to implement the scheme of amalgamation. So accounts of assets and liabilities are closed through realization account. A purchase consideration is calculated, that is, purchase consideration is equals to assets taken over minus liabilities taken over as per the revised value of assets and liabilities taken over by the new firm. A realization account is credited and new firm account is debited with the amount of purchase consideration. So any profit or loss on realization is transferred to partners capital account in their old profit sharing ratio, and capital balance are transferred to new firm's account. So accounting procedure to follow in the books of old firm by realization method. First, open the capital account of partners. Then second step, distribute undistributed profits such as unreserves, general reserves, etc. Third, transfer assets and liabilities to realization account. Fourth, account for purchase consideration. Fifth, dispose the assets and liabilities not taken over. Sixth, pay for realization expenses. Seventh, close realization account and transfer its result to partner's capital account or partner's current account in their profit sharing ratio. Eighth, at this stage, current account of partners is given. If given, are transferred to the respective capital account. 9. Transfer the capital balance to new firm's account. So these are the steps which is to be followed while preparing the books of old firms for realization method. So this was all about in this video. Next lecture we will solve one practical example of amalgamation of partnership firm. Thank you very much. Please subscribe my YouTube channel, like and share the video, and do not forget to press the bell icon to get the latest notification.